Good evening and welcome to tonight's live webinar for members only. We cover the ASX investment opportunities in review for the 9th of November. Any individual reading this or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Investor Signals provides a broking account service. We cover our algorithm model portfolios across the ASX 20, 50 and 100 as well as the US S&P 100. We have our high conviction portfolios which include access to the ideas expressed in the recordings and on the daily blog, and we can operate an independent portfolio where we work in partnership with you to execute ideas that we jointly agree on, and we also have access to derivatives to enhance the portfolio returns. The technology that I'm using tonight is the Investor Signals member area. You can subscribe to it for $1,320 for a year, or you can obtain a free trial by visiting investorsignals.com. The graph on screen is the Nasdaq, and just before we get into the ASX stocks, I just want to spend a little bit of time on focusing on the post-election response in the market. The Nasdaq is under sell conditions. I expect over the next 3 to 6 months we'll see a sell-off and a switch back to buy conditions. But for the moment, we're back up retesting these old highs, and you can see there that I've just put a support line underneath the sell-off, albeit it was only a small sell-off, and I've created that as support. And as we go to the live charts here, let's take a look at the Nasdaq, and specifically what I want to focus on there is a reference point to at what point are you staying long the market, and then at what point would that be a change in sentiment where you might become a little more cautious. So the issue with the Nasdaq hasn't changed in that the companies trade, a large percentage of the index trades on extremely stretched PE valuations, and whilst interest rates are near zero and the companies are delivering earnings growth, that stays in place, but obviously any shift in risk appetite, these high PE stocks are one of the areas that get hit quickly, and we've seen a bit of volatility pick up in the Nasdaq over the last few months. So for that reason, what I've done here is say, look, we're post-election rally. No one really knows ultimately what the strength of that turns out to be, so having some long exposure makes sense, and you want to be in the right stocks, and we'll focus on those tonight. But a reversal back below that support line there of a roughly 11,700 points, and I'll continue to draw your attention to this on the blog, especially if we see a reversal back lower. But at the moment, the momentum indicators are trending higher, and you need to view that 11,700 level as support and keep long exposure in the market whilst the index stays above that. Where part of the struggle in the market is at the moment is the other equity indexes are under algorithm buy signal, so we can see the S&P off 3200 is a buy signal, and likewise the XJO is under buy signals there from around that 50 level and continuing to push higher. The price action's above the moving average. For those joining us for the first time tonight, I'll just sort of highlight what the model is that we follow. So the switch from sell conditions into buy conditions, which is the green box at the bottom, looking for the complementary green arrow pointing up, and for shorter term traders they may also look at the momentum indicators, looking for the stochastic to move higher or looking for a close above the average. So when we look at the XJO at the moment, it's certainly extended, it's above the average, but maybe we got our first sort of warning sign here where we've got the short-term indicator pointing lower, but until such time as the price action came back down below that average, I wouldn't be acting on this. So we'll keep an eye on the XJO above the average, and we'll continue to watch this stochastic for a rollover in the days or weeks ahead, and again I'll keep you updated on the blog in that regard. But the Nasdaq remains the leading indicator. It is under sell signals, and there's reason for maintain some level of concern there because of those valuations. So let's go into the ASX Top 100 this evening, and we'll roll through these in a specific order. So this is the members area, so as a subscriber or a trial user you're getting access to this technology, and if you'd like more assistance on how to use it, don't hesitate to give the office a call, and I'm available to walk you through it. But we start off by getting the percentage gains to the top. We come over here, organise it in buy signals, so we're going to toggle through all the stocks under buy signals first. Then we're going to get a certain way through the list and they're going to switch to sell signals, and I'll comment on those from the short side of the market. So TPG is a stock that I've been commenting on the blog. I was saying that it was cheap at $7. We're now starting to see a breakout. Hasn't quite rallied 10%, but close to it. And we hold that in client portfolios and continue to think there's upside there from the cost synergies coming from the Vodafone acquisition. REA Group switched from sell conditions there into buy conditions in September. Support is at 106. Some of the investment banks are putting out notes around their concerns with valuations on REA, but again it stays above the moving average, but the first warning signs there with that short-term momentum indicator. But REA is a stock that sits in our ASX 100 algo model portfolio. Fortescue, been under buy conditions for quite some time. If we backtrack, it's been under buy signals since July 2019. We've had a subsequent signal here at around 1550. The stock is above the moving average and we're holding that in portfolios. QBE, this has been under pressure a little, and it's only really now that we're starting to see a green arrow and a breakout above the moving average, but it's not a stock that we're holding in client portfolios, but it is in the top 100 model. If you'd like to review the holdings in the top 100 model, you can do that by clicking on the model portfolio button. A2 Milk, so worth just pausing and having to think about what's going on here. Obviously this has been under pressure with the closed travel access into China impacting some of their distribution channels, but after the stock correcting from $20 down to $13, we're now seeing the green arrow, the stochastic moving higher, and you could think about this as a not so much a counter trend, but really more of like a breakout trade, where as long as it stays above that average, you could participate in some upside potential there in A2 Milk on a short-term trade basis. Afterpay switched to buy conditions some time back, so the original buy signal was there at 25, now pushing 104. My view with Afterpay is if you're not already participating in the rally, just be patient, and over the next 6 months we'll see it sell off and another algorithm buy signal, and we'll take a look at it then. Appen Group under buy signals there at $30, so the original switch was from sell there to buy here. And then we've had a couple of subsequent signals. It is under green pivot point arrow, price actions above the average, so it continues to tick the boxes there, but again not a stock that it's not part of our high conviction or core portfolio, but is in the broader algo model. Aristocrat Leisure, this is in our portfolio, so this switched from sell conditions into buy conditions there at around $28. Above the moving average, is under a negative pivot point, but the primary indicator remains this, so we continue to hold that in portfolios at present. JB Hi-Fi, under algorithm buy signals, but from a fundamental standpoint, it still looks a little bit expensive, and I'd like to have a look at that on the next actual algorithm buy signal. Ansell, this is one that I've been supportive of and commented on the blog. We had this buy signals originally switched from sells to buys at around this $30 level. We've had subsequent higher low here at around 35. Remains above the average, but maybe just the first warning sign there that's just starting to get up in. And if we look at from a fundamental point of view, Ansell's delivering terrific earnings growth. The management's confirmed an optimistic outlook, but maybe up at around $43, $44. You want us to think about either taking profit or selling calls. It is starting to get up to a level where it's relatively expensive and due for a consolidation. Illumina Group, I'll point out this is one that has obviously bumped sideways for the most part of 6 months now. It is showing that negative arrow, so I just think there's better opportunities from a trading standpoint, but I will highlight that a number of brokers have price targets and a fairly optimistic outlook there on Illumina up at around $2, but it's not really a stock that we're too active in anymore. We looked at it and had been participating in it, but we've obviously decided to reallocate that capital in other areas. Flight Centre, not doing too much there, but again, just highlight it is under buy signals. It's got the positive arrow and price actions above the average, but we just want to see a bit more certainty there. Computershare we do hold. We like this from the support level there at around $12. We took action on this from the switch from sell signals into buy conditions off that $12 support under a green arrow with a price action above the average. So continuing to set up in a fairly strong pattern there. Sonic Healthcare, we've seen the switch from sell into buy conditions. I've highlighted on the blog the entry opportunity there at around that $31 level, and then again there at around 34. But a little like Ansell, you're starting to get into a compressed dividend and fair premium for Sonic Healthcare, so either selling calls up at these levels is a way to drive extra income without necessarily having to sell high quality stocks. Wesfarmers, really like the long-term fundamentals here. The more they start to ratchet up the advertising and brand awareness of Catch, I think it could be a substantially undervalued asset in Wesfarmers. And sort of the trifecta of Bunnings, Catch, and Officeworks, I think sets them up as a pretty good product offering across sort of that whole e-commerce and online shopping push. So, I think Wesfarmers is something that I think we ought to keep coming back to and revisiting. Next DC, have some concerns on the accounting side there and just have struggled to get comfortable with that at the moment, so not doing too much there. Ramsay Healthcare, this is one I flagged on the blog, so we like this off this $61, $62 level. Maybe back up at it. If we look at the range, anything back up above sort of $65 to $70 maybe is an area that you start thinking about taking profit. But the long-term fundamentals there for Ramsay are in place where you could certainly be a long-term buy and hold client with that. Fisher & Paykel, like Ansell, I think this is in the right space with growing earnings, and it's one of the companies that you need to think about in your portfolio. It is expensive, so again, owning it, selling covered calls is the way that I think about Fisher Paykel. Cube Holdings, we've added this into portfolio, so we like this off the algorithm buy signal. Again, a switch from sell into buy there at around that 250. I highlighted this on the blog. The stock's been trading well off that higher low formation of 255, pushing up towards around $3. But on a 2-3 year outlook for Cube, it looks attractive to me on an earnings growth potential. Transurban, there's a bit of a tricky trade, but we did take it. We've added this into portfolios off at this $13 support level. Stock now pushing up towards $14.50. With some uncertainty around what the dividend looks like over the next 12 months, I think if you went out another 12 months, it's a return back to normal payment, which was getting up to about 58 cents per half dividend payment. We're probably going to see something around the 40 cents, at best for this year. So that would put fair value in Transurban maybe at a max back up to $15. But obviously with interest rates coming down last week, anything with a fairly secure dividend yield starts to look attractive and is being repriced. Brambles, so this is a stock that I really like the fundamental story. I was pleased to see management's reaffirming guidance, which is going to be in the range of say 3 to 5% earnings growth. Puts a stock on just under a 3% dividend yield. Should get back up to retesting at least that $11 level, but I think we could be looking at the beginning of a more substantial uptrend starting to form in a long-term base in Brambles down here. So I really like the look of that stock. Orica, support's been a tricky trade, this one, a little bit, if you probably compare it a little bit to Alumina, obviously completely different commodities, but just from a chart standpoint, it's had that sort of consolidation phase, it's tested the lower end of the band. The balance sheet is in good shape, but the earnings disappointed this year, or at least in the last quarter. But the outlook for the mining industry remains strong, and I wouldn't be surprised if this kind of low holds and there's the potential there for an uptrend to build. Again, reference, when it stays above the moving average. ResMed, I think, is getting expensive up here. They did deliver surprisingly strong earnings growth after a slight miss the last quarter, but again, it was under algorithm buy signals there at around $23. Again, in June of this year, and then if we backtrack a bit further, sort of buy signals there at $20, and if we go back even further, buy signals back in 2018. Where we sit at the moment is we've really had the bounce off support, the cross above the average, the positive arrow. Now we're kind of getting into an area where maybe the stock's starting to get a little bit expensive again. Sydney Airport's a little like Transurban, it's hard to get too much visibility on earnings, and Sydney's obviously far more substantially impacted than Transurban, but it's a way of playing the recovery trade to a reduction in COVID cases and a gradual return to travel, if it domestic or small bubbles, and then eventually maybe over the next 12 to 24 months more normalised international travel. So Sydney could just be purely a sentiment recovery play, but reason for some caution there. But as long as it's above the moving average, you could think about that as a momentum play over the short term. The XTO index, similar to the XJO, bouncing off support there and above the moving average. Again, just sort of think back to what's happening in the Nasdaq. Use that 11,700 level as your support. A break below that in the Nasdaq, you might take a little bit more of a cautious approach to your portfolio allocations and think about which stocks you want to lock in profit if we see the Nasdaq reverse back down through that 11.7 level. North Star Resources is merging with Saracen. Terrific gold business and gold play across whether it be Saracen or Northern Star. Our preference at the moment has been Newcrest and Gold Road Resources, but certainly exposure. However you get in exposure to gold, whether it's GDX or through the names I just mentioned, Northern Star or Saracen. But if we look at the algo engine, flagged the buy signal there at 1280, stock now pushing up. It is one of the core holdings in all our algo models. The ASX shifted buy signals back here at around $82. You can see there that I've placed the support at around 78. This is a stock that I drew your attention to on the blog. We're now seeing the price back above the moving average. The whole interest rate story and income opportunity that ASX offers, the yield would be down to around 2.5% at the moment, so it is expensive. And they're unlikely to grow earnings significantly this year compared to the same time last year. So maybe full value for this is back up at around that 87.50, but probably well supported in this market where money's coming back in looking for yield at the moment post the election. Coles Group support there at around that $17. Coles and Woolworths look very attractive to me, again, in this environment where there's a search for income. Probably as we get up towards this $19, $20 levels, full value for Coles, so you want to think about selling call options. But if we look at the history, it switched from sell conditions into buy conditions, and it was a focus of the commentary on the blog. You can see here from a short-term standpoint, it's trading above the average, but that red arrow, you can start to sort of draw a conclusion there around fundamentals. We're around that $20 level, should be pretty close to full value for this current breakout. Saracen, as I discussed, merging with Northern Star. Cleanaway Waste Management, so we've bought this on the pullback, pretty close to the lows there. From some client accounts we've traded out of it and taken profit, but it does remain in the algo models, and continue to like the fundamental story here for Cleanaway. If you take a 12 to 36 month view, the business should be able to deliver stable earnings growth, and again in a environment where people are searching for income, Cleanaway is a reasonable allocation in portfolios. Beach Energy, oil, my view on oil's been that now's the time to get exposure to it, but the rally may not really begin until the early part of next year. How you want to take exposure to oil, you've either go the O oil ETF, which is a beta share ETF, or you go recovery play in Woodside Petroleum, Beach, Santos, Origin, and you could really pick any of those names or put a basket together of those names. I suspect they do better next year than this year, and that even that obviously takes into account the Biden victory and the Democrats' push towards clean energy. But I just think the setups there maybe for oil to have a breakout move higher, especially if we start to see COVID cases reduce globally. So Beach Energy, think about that, but you might want to also use stop losses. If you're taking sort of more of a trading approach to it. Newcrest Mining, support there at around that $29 level, price above the moving average. It's under current algorithm buy signal. I think we look back in the in months ahead and recognise that gold's cheap. Maybe one of the drivers for a rally in gold will obviously be any stimulus measure that the Democrats announce. If they're continuing to print money, it's going to be bullish for gold. AusNet Services switched from sell conditions to buy conditions there at around 167. It's pushing higher. Spark Infrastructure currently under buy conditions. I don't follow the recent earnings on this too closely. I think when I last looked at them, the earnings were growing, but less than around that 5% mark. A number of brokers are fairly bullish on Spark Infrastructure, so just keep an eye on that. Support around that $2 level, and it is above the moving average. It could be a level where we start to see some consolidation and then a move higher, so we'll continue to look at that in the weeks ahead. APA Group, I like this coming into the December dividend. I think there's an opportunity there. Worley, so just jumping back to APA, to put that in context, I don't think the earnings growth is going to be there over the next 6 months due to the cost overruns with one of their new projects. But again, in a low interest rate environment, it's a fairly bankable infrastructure asset, and we're likely to see that sort of move higher over time. Worley's, so now what's happened is we've switched out of stocks that are in buy conditions into stocks that are under sell. So part of this exercise is, if we were shorting, are there any companies that we would want to look at? And then also just thinking about, within this basket that's under sell conditions, are there any counter trend trades there that are really appealing? Now my preference always is to find buy opportunities out of the stocks that are under buy conditions, but sometimes as you're moving through these sell conditions, the fundamentals maybe overpower the technicals a little, and there's an opportunity for counter trend trades. Worley, I've always been a little bit cautious on this. It's mostly traded sideways over the last 6 months. We'll just keep an eye on how it behaves as it really gets up to around that 1075 resistance. WiseTech not doing it there at the moment. Seek, cautious on that, as we've discussed in prior weeks. BlueScope Steel, look up against resistance maybe, but in line with all the market, you'd expect to see most stocks above the moving average, but might get a little bit cautious here if we see it trade back down through that average. So we're not doing BlueScope at the moment. NIB Holdings, not doing in the health insurers. Incitec, this is one where I'm comfortable with the balance sheet, and you may want to keep this on your list of potential counter trend trades. In prior weeks, I've highlighted that around that sort of around the 220 level would be resistance, and we could be starting to see the beginning of a new uptrend emerge. So a way of approaching that could be to put a support line under there, or just simply think about it, as long as it stays above the average, which we're starting to see there, we may be looking at the early signs of a recovery rally in Incitec. Whenever you're trading these counter trend moves, you need to really be cautious if the market reverses back down and takes out those lows. But fundamentally, I think Incitec's balance sheet's in good shape, and they should start to grow earnings again. Medibank Private, you're seeing this race for income in the market, and Medibank oversold from 370 down to 250, but I'm still just not convinced that the actual fundamentals for the business or that health insurer sector have materially improved. So maybe, whilst it does look like it's in a bit of a counter trend breakout, maybe there's other opportunities in the market. James Hardie, terrific business. It's going to switch back to buy signals. We'll see a sell-off at some point, and we'll see an algorithm buy signal over the next 6 months, and that'll be added back into portfolios, but not at this stage. Crown, again, part of this recovery play, and I don't think anyone could draw a conclusion that these businesses are producing the same income today as what they were prior to the pandemic. But on a 2-year outlook, they are likely to get somewhat back to where they used to be at a revenue and profit line, but I still think they're in for some tough trading conditions. So it's just how patient investors want to be in buying into, but they're fairly bankable. I think that that they will trend back towards those original levels of profit, but at least a minimum of 2 years, I think. Domino Pizzas, we're going to be patient with that, wait for a more material pullback and a buy signal. BHP, this is one that we've bought into as a counter trend trade at around this $34 level. It started to look oversold. Still BHP, Rio, Fortescue makes sense. Car sales, looking for a more material sell-off. It is a fabulous business, growing earnings, and we'll keep an eye on it, but we might be waiting 3 to 6 months for that to be added into portfolios. Insurance Australia Group, oversold, seeing a little bit of a bounce, and it is a high quality company that's gone through a significant hit to earnings at the moment, and it's just a matter of how patient, how much you want to really wait for confirmation those earnings are getting better, or simply go, this is a quality name that's had a tough trading period, and it presents an oversold opportunity. And it is a high quality business. Berkshire Hathaway has invested in Insurance Australia, and I think it's the only company in Australia Berkshire's ever invested in. South32, big hit to earnings, down 50%. Commodity prices down 50%. How much lower can it go? Is $2 a support level? Well, you can't trade every stock in the top 100, so you have to pick and choose which ones you focus on. But I just highlight that South32, maybe a little like Incitec, starts to make it onto that list that you want to just watch for breakouts. Suncorp, a bit cautious there. I think, again, you can't trade everything, but Boral up against maybe resistance there. Vicinity not doing there. Evolution not doing there. ALS maybe up against resistance around $10, but not doing there on the short side or the long side. Treasury Wines not doing there. Rio we like, so we've been buying that on that sell-off. Soul Pattinson not doing there. Qantas again not doing there. Reliance no. Challenger no. Charter Hall no. Santos, so think about that in that energy basket. So again, the triple O ETF, or just have a small exposure to a diversified number of these energy names. Horizon, I think this is just an oversold story here at 375. It's got yield support, but sentiment was impacted with Horizon with the tariff issues with China on coal, so that you can understand why that's been oversold and maybe going through a little bit of a relief rally at the moment. Iluka, I quite like Iluka and the recent spin-off. I posted about it on today's blog, DRR. Maybe if you haven't read today's blog, revisit that and have a look at what I commented on there, but Iluka looks okay. Ampol I like. I think this is in the sort of process of moving from the oversold level at 23 back up towards the top end of this range. So whether it consolidates at 28 or $30, but I think that's the pocket that it's heading to. Atlas not doing there at the moment. Magellan looks like it's going to get back up and maybe test that $65 level. Obviously that'll come under pressure if the Nasdaq moves lower. Nine Entertainment resistance up there. Telstra Corporation, so this is one that we're focused on the blog and in prior recordings, that it was in oversold conditions. It's now moved above the average, and that's been a good short-term trading opportunity in the market. Aurora not doing their preference, Amcor over Aurora. Oz Minerals, we certainly like the fundamental story here, and this will be one we'll watch for a buy on the dip opportunity over the next 6 months. Mirvac not doing there at the moment. Downer EDI preference, CIMIC over Downer. Goodman Group, this is just extraordinary, the strength in this stock and how compressed the dividend yield. The PE ratio is now getting up in excess of 30 times earnings, which is just unheard of for a property trust, and it's now trading on a 2% yield. But the reason why is they just came out and reaffirmed earnings of 9 to 10% growth. The stock, after owning it from much lower levels in the models, from sort of $10. It did switch to sell conditions here up at around $15, and it's had this strong breakout higher. So again, when it corrects lower, you'll see it switch back to algorithm buy signals, and that's when we'll look to add it into portfolios again. But it's certainly setting up for again for a future algorithm buy signal. Altium not doing there at the moment. Woolworths, so we really like this, but like with Coles, sort of getting up into that top percentile where you might want to think about selling calls over it to drive the extra income. Origin, part of that energy recovery basket. Oil Search, possibly part of that basket. I think Oil Search carries a little bit more geopolitical risk with Papua New Guinea exposure and some of the issues they've been having with the PNG government. But often they're part of the bargaining process, and I'd be surprised if they end up not settling a deal with the PNG government and continuing the expansion of the LNG development in Papua New Guinea. Link Administration under takeover offer. CSL, obviously great business, 40 times earnings, a 1% dividend yield. Is it getting a bit expensive? We've just become a little bit cautious on it given that it's switched to sell signals, but I don't know that the downside's really that material there in CSL. NAB, I found it interesting today that we had a sell signal here in NAB, so we're at a really difficult inflection point with the Australian banks. Is now the time to buy them, or is there more pain ahead next year on their balance sheet? What I suggest as a way of looking at these is that we've got the sell signal, we've got the red arrow, the price action's above the moving average. If we were to see the Nasdaq break that 11,700 level and the price move back below the moving average and the stochastic rollover, you've got a good setup there to think about short opportunities in the market. If you're wanting long bank exposure, the way we're doing it is through the BNKS Global Banks ETF, and as I explained last week, that's mainly due to it picks up our main preferred exposure being JP Morgan. Coca-Cola Amatil shareholders are being a bit stubborn there, and rightfully so, and seeking a higher takeover price. They think on average maybe it's about 10% below fair value, so we'll continue to see what happens with that story. Xero, analysts are upgrading the earnings outlook here for Xero. Again, we would like to buy this on a pullback on the next algorithm buy signal, but we might be waiting 3 or 6 months for that. Woodside Petroleum, part of that recovery basket. Just think about how you want to have exposure to oil going into next year. Commonwealth Bank, not under a current buy signal, but the pattern's the same. Sell signal, negative arrow, but be patient and wait for it to be below the average. A break in the Nasdaq below 11.7 will see me focus back on the short side of these banks on the blog. Macquarie earnings really came in roughly in line with market consensus, so there's no material change there. But earnings were down 20 to 30% on the same time last year, but it was what the market was expecting. AMP not doing there at the moment, GPT not doing there. Amcor I like, and I think this is something that you can continue to have exposure to, sell covered calls and get a 10% cash flow off it. I think the downside risks in Amcor are relatively low. Scentre Group, cautious there. Cochlear, cautious there. Bendigo not doing in the regional banks, which includes Bank of Queensland. Stockland's maybe up against resistance at around that 450. Star Entertainment. So I'll just stop on this and talk about this on the short side as well. It's not under current algorithm buy signal, current algorithm sell. Well, that is its most current signal, but it's not, in the last few weeks. So it is under sell conditions. It's got the negative arrow, but the price is above the average. But when I think about the stocks that are probably likely to struggle and make it onto the short list, and I might put a post on the blog tomorrow just of sort of the top 10 stocks that I think you might want to have a think about, or at least keep on a short trading list. Star Entertainment makes it onto that group, so if we see the Nasdaq back down below that level, it'll be one of the names that I'm revisiting, as is the case with Westpac. I think it's under sell signal, negative arrow, and I think when the market at some point starts to take profit and roll over, then these are the names that you'd focus on the short side. Dexus, under sell signals, not doing there. Lendlease, I think good business, up near resistance at around $13. Tough trading environment for Lendlease, but good long-term opportunities. But what we're unsure of is the pressure on their balance sheet at the moment. AGL, little bit of a counter trend trade there at the moment, a little bit like Telstra. I think it's worth keeping an eye on, but the fundamentals are pretty tough there for AGL. ANZ under sell signals, negative arrow. Let's again keep an eye on what happens in the US for the shorting opportunity on the Aussie banks. Tabcorp Holdings not doing there, and then there we are back to TPG. Just to finish this evening, I just want to have a look at a couple of ETFs. So the GDX, which is the gold ETF. So this is one that I flagged on the blog. So buying it off that 51.50 level, now pushing up to 57. The BNKS, so this is our preferred way of holding bank exposure at the moment. So it's getting support there off 433. Still some risks around the banks, but you taking a diversified basket approach, and you're getting exposure to, if the banking sector is going to recover, it's going to start with JP Morgan. VBLD just started doing some stuff, some trades in this again today. It is under algorithm sell signals, and you won't very often see me do this, which is put a support line and sort of highlight value in a stock that's on. But again, given that this is broad exposure to global infrastructure, low interest rates, I'd just be surprised if we see another major leg lower in this. I think we're more likely on support, and the fundamentals may support a continued recovery and a buying opportunity in that. The Cure ETF, we've seen the biotech stocks in the US break out, and the Cure ETF should be a beneficiary of that. So $60 is support, and I think that over time trades higher as well. And what else do I have on the list here? The Spider Global Dividend Fund. So again, a bit of value starting to creep into this at around that $15 level. So that, I think that covers it. So just to recap, look, I think the stocks under buy signals that we like: TPG, Ramsay, Newcrest, Wesfarmers, Brambles, Cleanaway, Cube. And if you want to have a chat about any of those further, please give me a call in the office. And just to remind you what you want to watch out for in the market, and is let's keep an eye on this Nasdaq. It is bullish at the moment, but a reverse back below that 11,700 level is maybe the catalyst to start having to think about where you want to trim gains in the portfolio, and think about sort of the hedging basket and possibly even short opportunities in the market. And I'll keep you updated on the blog. Thank you for listening in. I look forward to speaking again next week.